All right, check, radio check. This is part two of a topic we did last week, which was what was your core strategy, and to help put it in to give a visual and put it in context. Once an investment strategy has sort of been diagnosed and suggested, there are ways or items that help make it a little bit more unique for families, and we're going to reference that as satellites. And there are a couple things that we at Professional Planning Services and ultimately, one of our RIA, Brookstone, offers, and that's what we're going to talk about today. This is not designed to be, an end-all be-all, but one of the things that you will be running across as you're at your employer and 401k and 403bs, they don't have access to these types of techniques, and there are things that on the horizon that have us at Professional Planning Services causing us to pause a little bit. Now, we're not screaming, hey, the sky is falling. We've never been that type of investment firm. However, we do pay attention to the writing on the wall. And so, my number one pause for caution is we have mortgage rates above 8%. It's just a matter of time until that starts to bring the economy to a screeching halt. Whereas before, at the beginning of this year, I had said Q1, Q3, Q4 of this year, and I've now pushed that out to Q1, Q2 of next year. But today makes it very hard, when you see 500 plus points in the Dow, right? That you see swings that are just monumental. That's volatility. And there's things that you can do to take advantage of that. But we also don't want to, once you make that money back, you don't want to give it back once you have it. So that's really the purpose of the satellites is diving into what is your goals for you and your family, whether that be, once we have a core determined, then do we want to create some type of income? Are you approaching retirement and we maybe want to take the income that's being generated by the portfolio and reinvest that? Or do we want to be defensive in nature? Or do we say, you know what, I'm okay taking a little bit of risk with some guardrails? And that's really what some of what we're going to talk about here today. So one of the satellites that Brookstone offers is something called structured notes. And there's quite a few different designs that can be implemented. But first, we have to understand, what does that mean? So a structured note is a financial instrument generally issued by large, well-known financial institutions. The terms of the notes vary both in time and maturity and market exposure. Each month, banks bring out the list of their calendar offerings. It is important to point out that the issuers split their calendar terms between brokerage offerings which pay upfront commissions and advisory offerings. And then because advisory offerings are for a fee base or fiduciary advisors, the issuers can strip out some of these commissions that are otherwise going to eat away at some of the returns and actually give you a better grade of note, for lack of a better term. So structured notes, structured notes are financial instruments which consist of two main parts combined to generate a specific risk/return profile. In their most basic form, structured notes are investments that combine a low risk, low return component of bonds with a high risk, higher return derivative on a selective asset, often equities or equity indices. So you can see bond plus derivatives, and that's a fancy way of saying something like a call option on with a cap, right? And then that would equal the structured notes. So these are predefined terms, and that's actually going to be the next bullet point here. Structured notes are not one asset class, but a type of product structure that is created to meet different client financial objectives, such as income or growth or principal protection, as I alluded to earlier. What differentiates the structured notes relative to other financial assets is that they are one of the few investment vehicles that we can actually provide a defined outcome. So we already know what we're trying to achieve versus some of these traditional ways of investing, which is what is our 10-year average, right? So here are some important terms, glossary of terms. I'm not going to read every definition, but a lot of us already understand dollar cost averaging. If you're participating in some type of 401k or 403b at work, final value, lesser performing index, return, index return, initial value, monitoring period, review dates, the Russell 2000 index, which is small caps, S&P index, which are the blue chips, trigger event, trigger value. These are things that are typically when I'm speaking with clients and we're saying, hey, how is my portfolio performing, that I will touch on some of these definitions. But the first step when bolting on a structured notes, first of all, it's the investor profile. Is it suitable for everybody? And the answer is no. So when we're getting together, one of the things, what is the investor's your investment time horizon? Are you willing to sacrifice higher returns in exchange for limited principal protection? Are you more concerned with meeting specific goals than achieving more alpha? Does the investor have specific income needs? Are you able to sacrifice access to capital for longer periods of time? These notes that we use are 1 year, but there are longer terms, right? So you just need to let us know what you're looking for. Does the investor have a bullish or a bearish or a neutral market outlook? And can the investor do without a regular stream of income for a little while? So if we lock this money up, even though, we can generate an income stream, we just need to know what you're looking for. So the answers to these questions should help you to ascertain whether structured investments belong in your profile. At a minimum, taking the time to gain a better understanding of your financial goals and risk tolerance can be its own reward, as it may lead to deeper, more productive client relationships. So my point is, these are not mainstream. You can't walk into your Wells Fargo or a lot of these banks or financial institutions and say, hey, give me this. Brookstone is one of the largest purchasers of these types of strategies, and they're using banks. And I've been using these for years now. And there are points where, with a little bit higher rates of return, you'll hear me talk about the American style has a little bit more risk, but there's a little bit more return. I tend to be having my clients go into what I call the European style, and I'll get into what those mean. So how do they work? So while different notes have different investment goals, really, let's just start with payments at review dates. So the first thing is, let's just say if we put $1,000, it's linked to an index. If the closing level of the index is greater than or equal to its initial value, right? There's what they call an automatic call. Notes will be automatically called, and the investor will receive their principal plus whatever coupon payments or income that they've gotten. So the math that I use here, let's just say it's 10%, right? You got a 10% note, and it's a 1 year note. It's no call for 6 months. But on 6 months, remember, you would have gotten 6 months of premium or coupons, which would have amounted to about $8.30. That times 6 months would put you at about 5%, half of the 10% of the APR, the annual return. Well, that being said, if they call the note, and why would the bank call the note? Well, let's say that right now, that when they offered the note in, say, January, by June, right, that they turned around and said, hey, you know what? We can lend that same money out and only pay 9%. So it's an auto call if they do that, and they will guarantee your return of principal. And then all we do for clients is we reinvest in that month. Now, if the closing level of the index is less than the initial value, then they will just keep at it and it will continue on. And remember, you're going to see that these notes on the downward protection side below zero, there's a 30% protection on the downward buffer. So if the final value of the index, so now we're going to talk about, mid-year versus the Euro styles, which is point to point. If the final value of the index, and remember, on the notes that we offer at Brookstone that have been designed, there's 3 indices. So it's the S&P, it's the Russell, and it's the NASDAQ. You're only going to see them reference the Russell and the NASDAQ here. I'm sorry, the Russell and the S&P here. But typically the notes to get these rates that are, we think above average yield right now, which are in the 9s, 10s, 11%, that they're tying it to 3 indices, and that is a point to point. So if you, let's say the note was negotiated on January 1st of 2023 and it hadn't been called, it will come due on January 1st or, of 2024, 1 year later. Are the indices above that initial 30% downward pressure? So let's say if the indices was 1,000, is it above 700? If it is, then you get your principal back. If the market has corrected, and this is why we dollar cost average into it, we're not putting all of our money into 1 month. We're just trying to spread the risk and diversify the risk over time. So the final value of the index is greater than or equal to the initial value, or a trigger event has not occurred, the investor will receive their principal. So this is what's so great about it, is that you're getting the financial backing and the guarantee of major financial institutions, whether it be Citibank or Goldman Sachs or JP Morgan or Morgan Stanley, any of these banks that are negotiating. It's their full faith and credit that are offering these guarantees. And then if the final value of the index is less than its trigger value and a trigger event has occurred, right, then the investor will lose. Risk is possible, and loss is possible. But you're going to see on the next slide, and there's a lot of numbers here. So I'm going to ask you to either take a screenshot, contact us. We can send you a white paper on this, which gets into it. So I'm not going to give a full dissertation on the complete internal workings of a note, but understand that this next slide is really just talking about maybe 4 different possibilities that could happen with that same $1,000. So the first column here is flat market, 0% return. This hypothetical example shows 7% was the interest rate that was offered by the bank at the time. It said that these 2 indices, the 30% down, because it was a flat market, 1 year or during that year, whether it was American or Euro, that did not get triggered. Therefore, you get $1,000 back, or 100% of your principal, plus the interest that you earned over the year, for a total principal and interest of $1,070. So that's one possible outcome. Another possible income is that you had a down market, but it wasn't enough to trigger the 30% loss. So the S&P, let's say, was down 28%. The Russell in this example was down 24%. Neither of them hit the 30% trigger. Therefore, you're still guaranteed the principal. You're still guaranteed the interest in the coupon payment for the same net outcome of $1,070. And this is why they're so, to me, it's allowed me, for people that have been exposed to equities and some of the bond holdings or income portfolios, to allow us to heal clients' portfolios when they've had some stress due to downward pressure, both in equities and income or bonds. Down market event, but it was triggered. Well, in this example, it was 30%. Now it's the lesser of the two. So 32% was the S&P, but the small caps was down 35. So 35% from 1,000 would be 650 is all that's guaranteed, right? Because that's what it closed at, but they got the coupon payment. So although not desirable, somebody that was in the market with all the risk might have lost, 350 or 35%. In this example, it's only 28%. So it's just a way to buffer the losses. And remember, this is not because we had the wagon loaded in this 1 month. We would, if this did happen in 1 month, typically the next month is not going to have that same event. Or if it is 2 or 3 months in a row, you still have 6, 7, 8 months of the year that are able to help the portfolio recover and heal. Now, the note was called after the first quarter. And remember, if that happens, guaranteed to get your principal. In this case, it said first quarter. Ours are 6-month no call. But, depending on the call terms, this would have paid 1/4 of the 7%. And then trigger event with market recovery. So the market went down, it dropped, but it turned around and came back. This applies to the American style. And I've had clients that when we were in these, in the latter part of 2022, there were 3 months where we had downward pressure. So we got the coupon payments, but some of the values lost value. So hey, it's not ideal, but at least you don't have the complete exposure to the markets. And that's why I think it's a great buffer. It's a great satellite. It's a great add-on to be bolted onto a portfolio. And if you're over age 59 and a half and currently still employed, you should really give us consideration to say, hey, can I do a in-service distribution or rollover? And so that we can start to incorporate some of these strategies for your long-term into retirement. All right, so one last thing I want to talk about, Brookstone. I just did a video on this. If you looked on LinkedIn, it's probably there, but it's, they've created the BAM Summit series, and it's whether it's a core or a satellite version. They're just taking some of what Brookstone's investment team and strategies using ETFs. They have some really cool ideas and strategies that can help diversify and automate some predictable rates of return. And I really have liked what I've seen here. So I'm not going to do a full dissertation on the BAM Summit series yet, but if you do want to find out more, you want a prospectus on any of these ideas or strategies, please reach out to us. We're happy to help. And then lastly, it's that time of the year, folks. I just was up at Manalina's in Flemington, New Jersey, and picked up my first apple pie. Went up to see Janet up there. They are busy at work. If you would like an apple pie on my family to yours, from professional planning services to your family, all you need to do is let us know. Just email me, chris@professionalplanningservices.com. Reach out to our office, say, I would like a apple pie. And when you do that, you can drive up to Ringo's. It's right on Route 31 there in Ringo's on a predetermined date. I think it's coming up, I think the week before Thanksgiving. You can go pick yours up. So you can celebrate with your family. I already picked one up. I think I got one more slice left. And now I got to go back and get more when I pick up some of the final orders for us. But while you're there, I cannot tell you how much I love their lumberjack chili. I would make sure that before you go up there, you call them and say, hey, you know what? I want to get a lumberjack chili, because I know that I hit them for like 2 or 3 pints when I was there, and I think there was only 1 or 2, and it's got to be in advance. I don't want you to miss out. So just make sure that when you're on your way up there, if for whatever reason, call on a treat. And again, the other thing that we're highly likely to do, and keep this in mind, if there's a family that is less fortunate, maybe somebody's suffering, they just can't cook at this time of the year. Maybe, they don't have a lot of family. One of 2 options that we're willing and able to do. We can send from I was just talking to one of my clients who gives out free turkeys every year. We would like to do the same thing, but I'm not going to have people drive by and hand out turkeys like they do up there. My buddy Jeff Burke Plumbing and Heating, they do in Bound Brook. But Joe's Meat Market, if there's somebody that that could use here, we'll donate a turkey to them. We'll pay for DoorDash, have it delivered, or maybe even a pre-cooked meal to a family in need. So please just reach out to us. Let us know. It's our way of giving back. Life's too short. There's too much craziness in the world. And if we can help in some way, make somebody's life a little better, it's our pleasure to do so. So make sure you take advantage of this and get your apple pie. These are all the disclosures that we have to share. You'll see there's a couple additional ones, especially when we're around structured notes and some of the unique offerings that Brookstone has. So I'm not going to go too fast, so there's enough time for any questions, whatever. I've met my obligation from a disclosure standpoint. And lastly, we're going to play our last Brookstone disclosure.